Welcome back, everyone. Take your seats, grab your notepads, and let's get right into it, because today we are setting the stage for a rapid-fire, professor-led revision masterclass. We are tackling the final accounts of a company, specifically under the Companies Act 2013. So, whether you've got an exam creeping up on you, or you just really need to lock down exactly how corporate financials are officially reported, you are absolutely in the right place.
Okay, let's dive into this. Here is our game plan for today's explainer. We'll start with the foundations of final accounts, move into the trial balance baseline, then break down the P&L and balance sheet. After that, we're mastering the final adjustments and wrapping up with key ratios for company health.
Starting right off with Section 1, Foundations of Final Accounts.
So what exactly are we talking about here? Well, to put it simply, think of final accounts as the ultimate end-of-year report card for a business. They are prepared specifically at the close of the financial year, and their entire purpose? To reveal two absolutely critical things. First, the company's financial performance, which really just means how much money they actually made or lost. And second, their financial position, meaning exactly what they own and what they owe at that exact moment in time.
Now, here's the thing you have to remember. This isn't just about crunching numbers, it is about strict corporate law. Under the Companies Act 2013, all companies must prepare these statements in a highly specific, legally prescribed structure known as the Schedule 3 format. The law mandates that they present a true and fair view of the company's affairs. You can't just, scribble these on a napkin. They require official signatures from the board of directors and the CEO or CFO. On top of that, they have to be audited by a chartered accountant every single year and finally filed with the Registrar of Companies. The compliance here is absolute.
Moving right along to our second module, the trial balance baseline.
Look, everything has to start somewhere, right? And for us, that starting line is the trial balance. A trial balance simply lists all the ledger account balances for the business before we even touch the final accounts. It's organized neatly into two columns, debit and credit. But the absolutely crucial point here is our golden rule. Total debits must perfectly match total credits. If they don't, you're stuck. You cannot proceed. You always have to check that baseline balance before taking another step.
Now, quick side note, and this is a lifesaver if you're stressing about test day. While real-world companies have literally thousands of ledger entries, in your exams, a maximum of 20 balances are typically given in a trial balance question. So take a deep breath, don't let the raw data overwhelm you. You really only have to categorize a very manageable set of data points.
All right, let's jump into Section 3, P&L and the balance sheet.
Now, what's really interesting about these two statements is how differently they measure time. The statement of profit and loss, or P&L, is kind of like a movie. It shows performance over the entire financial year, matching your total income against your total expenses to reveal your ultimate net profit or loss. But the balance sheet, that's a photograph. It shows the company's financial position frozen on one specific date, detailing its assets against its liabilities and equity. So always remember, timeline versus snapshot.
Let's zoom in on that P&L movie for a second. On the revenue side, we're looking at income. This includes revenue from operations, so the core sales of goods and services, plus other income, things like interest, dividends, or rent received. Then we subtract the expenses, and these are bucketed very specifically. Cost of materials consumed, employee benefits like salaries and provident fund contributions, finance costs, think interest on loans, depreciation and amortization, and finally, other expenses like rent and admin costs. Total income minus total expenses, that gives us our net profit.
Next up, we examine the balance sheet photograph, and we're following that strict Schedule 3 structure we mentioned earlier. This breaks down what a company legally owes versus what it legally owns. On the equity and liability side, what it owes, we have share capital, reserves and surplus, long-term borrowings like debentures, and current liabilities like short-term loans or outstanding bills. Flipping over to the asset side, what it actually owns, we have non-current assets. These are your long-term holds: land, building, machinery, goodwill, patents. Alongside those are current assets, which are the more liquid items like inventory, debtors, cash, and your bank balances.
Okay, on to Part 4, Mastering the Final Adjustments. Now, adjustments are essentially pieces of additional information given outside the trial balance that must be factored in. And this is often the trickiest part. But here is another high-yield exam tip to calm your nerves. A maximum of 4 adjustments are generally asked in full exam questions. But listen to me carefully on this. You must always show the double effect of each adjustment.
because they weren't in that original perfectly balanced trial balance. If you only adjust one side, your final accounts will completely break.
So, how do we physically apply this double effect rule? It's basically a two-step dance. Step 1, you impact a statement of profit and loss, either adding to or deducting from an income or expense. Step 2, you impact the balance sheet, recording that exact same adjustment as either an asset or a liability. It's just 2 steps every single time, keeping those corporate scales perfectly balanced.
Let's make this concrete by chunking these heavy rules with 3 common examples. First up, closing stock. You deduct it from the cost of goods sold in your P&L and simultaneously list it as a current asset on your balance sheet. Boom, double effect. Second, outstanding expenses, meaning an expense you've incurred but haven't paid yet. You add it to your expenses in the P&L because the cost happened, and you list it as a current liability on the balance sheet because, well, you still owe the money. Finally, depreciation, the drop in an asset's value over time. You add this amount as an expense in the P&L, and you deduct that exact amount from the specific asset over on the balance sheet. Master these double effects, and I promise you, you'll master the exam.
And finally, we arrive at Section 5, Key Ratios for Company Health.
Once we have those finalized accounts, we can calculate critical ratios to actually grade the company. First up are our profitability ratios. The gross profit ratio is calculated as gross profit divided by net sales multiplied by 100. This metric shows us the company's profitability strictly before all those extra overheads are factored in. Then we have the net profit ratio, which is net profit divided by net sales multiplied by 100. This provides the overall profitability. It's essentially the final grade on how efficiently the company turns its sales into actual bottom-line cash.
But hey, profitability isn't the whole story, right? Survival requires liquidity. And that brings us to this magic number right here, 2 to 1. This is the ideal target for the current ratio, which you calculate by dividing current assets by current liabilities. This ratio is the ultimate indicator of short-term financial health. A 2 to 1 ratio simply means the company has twice as many liquid assets as it has short-term debts. It ensures they can comfortably pay their bills and keep the lights on.
All right, we've covered a massive amount of ground today, from the rigid Schedule 3 formats to the mandatory CA audits that ensure a true and fair view. But before you close your textbooks, I want to leave you with a final provocative thought to chew on. If a company's entire legal and financial health relies so completely on these strict formulas and adjustments, who actually holds the real power in modern business? Is it the CEO who makes the big operational decisions? Or is it the accountant who actually writes the final story? Keep that in mind as you head into your exams. Thank you so much for joining this revision masterclass. Keep studying hard, and I'll see you in the next explainer.